Alright YouTube, stocks by the numbers, welcome back here. We're looking at Portillo's, ticker symbol PTLO, listed here on the NASDAQ. There's a company, there's a restaurant chain here in the States. They're only in the States. And right now, $14.63, down almost $1 today, around 6.25%. As you can see, this company came out not too long ago. It was the tail end of 21. We had a big pop, a big run up to almost $60 a share. And then we just completely cratered down to sub 15. And this basically goes back to everything I've been saying with all of these newer companies. As you can see here, you know, it was a brand name company, and I understand they make like really nice chocolate cake and shakes and stuff like that. I'm sure they got decent food. I personally have never been to a location, but again, you can see obviously that just like every other IPO and even a lot of these SPACs, they come out, they're way overvalued day one. And even if you miss a little bit of a rally for a couple of weeks or even a couple of months off the hype, you're better off just waiting, especially if you look at the numbers. Looking at the company revenue is increasing. I cannot deny that. A lot of these fundamentals actually look halfway decent for the company. However, just consistently missing on the revenue side. This was their best quarter. Going back to basically this time last year, early November, the company beat on the top and bottom lines. And also, this is the only quarter since they went public that they beat on the revenue side. And you can see it was a pretty healthy beat there, 1.865 million. And moving forward, again, you can see that revenue has been increasing, 156, 169 million. However, again, they are consistently missing these estimates. And see, that's the problem with a lot of these newer companies. What you don't want to do is, obviously, you want to try to not have any negative catalysts attached to your stock. Because if Wall Street can bring it down, they will bring it down. This is what I always preach, right? I always talk about the companies that are heavily overvalued in the numbers or are trading at just insane multiples. Those are the ones that are going to take the biggest hits. And now you have a situation like this where the stock was, north of 15.5. Now it takes a huge chunk down, 6%, all because I think it was Morgan downgrades Portillo's to equal weight from overweight, cuts price target to 19 from 26, right? So that's about a 25% drop in their price target on Portillo's. And again, if you back it up, you just see it more and more. Jeffries lowers price target to 25 from 30, right? Baird lowers price target 26 from 30. Though I will say a lot of these institutions pretty much all have price targets higher than where the stock is currently trading. And it could very well get to that point at some point, right? However, the question is, do you have to buy it now? Just because they have higher price targets doesn't mean it's a buy. And in my opinion, with the stock today hitting new 52-week lows here, 1453, I actually think it could potentially go a couple of points lower. The one thing that will save shareholders here are these earnings coming up. Because again, this time last year, that was their best quarter on paper, so, to date. So if everyone is expecting them to come in above expectations here in about 3 weeks, then what's going to happen is probably over the next 2 weeks, it is either going to be down or flat. And that's why, it's been in this downward channel since the last time they posted earnings here. That's why I have a feeling it's going to stay in this channel until maybe like a week before earnings. And then they're going to start to rally it back up into like the 14s and the 15s. And obviously, if they come in and post some decent numbers, maybe you can have a pop back up to like this 20-day moving average here, and it can get back to like 16.5, 17 or something like that. So in the immediate short term, we could potentially have a little bit of a trade setting up. However, for the long term, if this was a position that you wanted to take a new position in, or you own it, up at 20 and now it's down here, so you're wondering if you should, average down. In my opinion, again, I do think it's going to continue to go lower. And even if we zoom in, now 3 months, even if we zoom in here, again, if we just kind of ride and potentially get back to the bottom here, because you can see again, you can see it dropped down hard, and then it tried to regain this fib here, 1466, and it rejected multiple times. So that's why, in my opinion, I have a feeling that it's going to drop again and potentially ride the bottom trend line here, even if it's just for a couple of days. But you can see, look at the price, you can see now we're at very, very low 14s, potentially even sub 14, this time next week if we're at the bottom trend line. So that's what I'm saying. That's why I always talk about pricing and timing, because of course it could be a buy here at 1463 or 1470 or whatever the hell. But again, the question is, do you have to buy it here at 1463 when you could potentially wait and get it for 1363 or even lower, right? Now, it may not seem like a big deal, but again, we're talking what? That's like a 6 or 7% move. So, it definitely adds up. But if we look at just the market cap to revenue comparison, it actually seems in line. The one thing that I feel, the one fundamental that's really adding to the sell-off may be the PE ratio. And right now we have a market cap, you can see it's a touch over 1 billion, 1.06 billion, and we just had a chunk down for about 6%. And if we look at last year's revenue, you can see for the year, 587 million. Right? So when you look at it like that, the company's trading less than 2 times last year's revenue, so we may view it at a discount. However, here, in my opinion, I think this is what Wall Street is preparing for. Now, as you see, it looks like Q2 is their best quarter, with the highest profit margin, you can say, right? 150.6 million, Q2 of 22, and you can see the profit margin there, 3.39%. Then we just kind of continued to step down, right? You had a little jump there from Q3 to Q4 on the profitability side, but as you see, the profit margin just kind of begins stepping down here after Q2. And now, boom, we have another pop back up here looking more positive for Q3 of 23, even though they technically just missed earnings. So now Wall Street may be anticipating that we're going to start stepping down now on the profitability, which is why they're looking to lower their price targets. And again, you have a lot of people now jumping on the bandwagon and shorting and buying puts, and obviously that's adding to the sell-off. And that's why, again, I have a feeling that it really is going to go down before it does go up. And I looked at this the other day when the stock was up at like 15.5 here, and again, I didn't get around to making a video. And it turned, I probably definitely would have had the same analysis. I definitely would have had the same viewpoint even a week ago, with the stock at a higher price. And now you can see, hypothetically, if I made the video, now you would have seen that the stock hit new lows, and I was on the right track there. And again, reason being is because while some of these potential earnings moving forward may be light, more importantly, I think it's the overall sector as a whole. I remember seeing this restaurant on like the Travel Channel years ago, and they were talking about their chocolate cake and how good it is, and they make cake shakes and all this stuff. Now all of a sudden the company is publicly traded, and they're trying to branch out, open up all these different locations and whatnot. However, as you see, looking at a lot of the fundamentals, they kind of seem to be struggling across the board. And now it's like, while they went public and they're trying to open these new locations, everyone else is kind of struggling with, increased service costs, labor costs, and cost of ingredients consistently increasing now, dealing with this hyperinflation BS. So that's what I'm saying. It's like this company, some of the numbers do appear to be growing, and it could be good over the years. However, here in the immediate short term, it's just not a necessity. It's more of a luxury to go out, get a burger and fries and, some decadent chocolate cake, and you're going to end up dropping probably like $60, $70 or something just to eat, go on a date or something to this place. And listen, I can appreciate the fact that people will always somehow find some extra discretionary funds to go out and have a good time and treat themselves. But, again, this almost makes me think of McDonald's. The way everyone said McDonald's was recession-proof, and the one thing McDonald's really brought to the table was the fact that for a few dollars you can get, a couple of items, and you can fill yourself up and supposedly, not on the nutrition side, but on the substance side, you can get yourself a decent meal for just a couple of dollars. And now if you look at McDonald's prices compared to a lot of their competitors, they're basically either in line and in a lot of cases more expensive now when compared to other fast food branches like, Burger King or Wendy's. So that's why it was like the main positive that a place like McDonald's brought to the table, which is a lot for a little, now is completely gone out the window. And that's why, in my opinion, I think moving forward, a place like that is going to lose market share. And that's why, very similar to a place like this, I just feel like the timing of when the company went public and the fact that they're potentially trying to spread themselves out too thin now with all of these locations, that's why I say I just think it's going to get worse before it gets better. And we may be able to get this stock down in the 13s or potentially even the 12s compared to today's price of $14.63. But again, I think it's the step down in profitability. I think that's what Wall Street is kind of expecting. But if we look again at the price targets, you can see as low as 19, as high as 36. So if these targets do get hit, obviously you're going to see a phenomenal return. But the question really is, when is it going to happen? And I really feel it's going to be years before you see like a $25, $30 stock here. I just think, again, that they're going to struggle before they get better. We have 6 analysts giving it a strong buy, 1 giving it a buy, and 2 giving it a hold. So everyone across the board kind of likes the company overall. But again, they're consistently missing earnings and revenue. So the problem now is going to be like in between each earnings report, the stock could run up a little bit because technically on paper it's undervalued. However, when the company reports earnings, as we see here, 6 out of 7 times, they technically missed on the revenue side, and that alone is enough to drop the stock down when they report earnings, even if they are undervalued in the numbers. And that's what I'm talking about, really. But I just wanted to go over the financials very quickly, and you can see here again, all in the U.S., revenue has been growing year over year, going from mid to high 400 millions now up to 587 million. So, they definitely are growing the business, but the question is, can they sustain the growth and actually turn it into more profitability, right? They missed, again, back-to-back years on the revenue side for 21 and 22, even though it was increasing. Now for 23, expectations of over 680 million. So the company really has to have a good quarter here. Well, actually, really good 2 quarters moving forward. Because again, even though revenue has increased, they're less than halfway there, I believe. We're looking at 325 million, the revenue of Q1 and Q2 of 23. 325, meaning that they now need to make over 355 million on the next 2 quarters moving forward. And I think it's going to be tight, and I have a feeling that they are actually going to miss again on the annual revenue side. But again, this is just my opinion. It's just my opinion. But on the EPS side, you can see they came in above expectations with a nice surprise there, 25 cents a share compared to 21 for the year of 2022. But again, that really, in my opinion, is not what is going to bring the stock up. It's going to be the beats on the revenue side. And we can see that the debt was up north of 480 million and kind of began to dip down here into the 300s. And then, of course, as of last year in 22, debt jumped up to 523 million. Now, of course, that is a negative, but also at the same time, the assets are outweighing the liabilities. So they have positive equity in the company, which is why I'm saying there are some positives, but there also are some negatives. And it's almost like usually what I'm noticing is that when you have a mixed bag like that of, technicals and fundamentals with some positives and some negatives, unfortunately, those stocks tend to go down faster than they go up. And of course, on the flip side, they tend to have a longer sell-off period and a longer just decreasing curve before it decides to find that bottom and actually begin to start growing again, which is why I feel, in my opinion, that the company is probably going to continue struggling for like the next 6 to 12 months moving forward, and we might be able to get a better price. But again, you can see the assets increasing, liabilities jumped up 500-600 million up to almost 900 million now. Assets minus liabilities gives us equity, as we see, 436.5 million, we'll call it. Not the lowest it's been, but also not the highest it's been, right? And the equity in the company was much higher when liabilities were, 30-40% less. So that's why I'm kind of struggling a little bit to kind of like decipher what is going to happen here. However, the book value per share has been steadily increasing. I do have to give them that. As you see here, 478 up to 484, and then got above 5 and just stayed there, 529, 533, as of last quarter, 551. So this, of course, is a very good sign. However, we've seen decently financially stable stocks, trading in line or even less than 1 times book value at times. So, of course, it is a very good indicator, but, it can't be the main metric that you go off of. Even right now, I think this is like 2.7, 2.8 times book value or something like that. So that's what I mean. It could be viewed as low, but also at the same time, it's not the biggest stock on sale. And that, again, is the problem. Because if the company does consistently miss revenue, or they constantly talk about, margins decreasing or costs increasing, any of those negatives are going to be bringing the stock down, or at least keeping it flat. And then what's going to happen is a lot of these fundamentals are going to line up more positively, and now what we have is going to be classified as a value trap, where we look at a situation like this. On paper, a lot of these metrics say it's undervalued, so we take a shot, but the company keeps dropping because people aren't paying attention that they're actually consistently missing earnings more times than not. So that's what I'm saying. It seems like we're going to be in this position where we could have a little bit of life in between earnings reports, and then we're just kind of potentially going to give it away on any downgrades or, price target decreases, or, again, slight misses in revenue, or reports of cost of ingredients increasing or anything like that, because again, that all has to be passed on to the consumer, and we're in a rough economy now where everyone's doing some belt tightening and pinching pennies, and that's what I mean. A company like this, in my opinion, is not going to come out on top, because now that they're publicly traded, their main priority moving forward has to be to maximize profits, and that's why I feel down the road I think it's going to get worse before it gets better, and they're just going to outprice the consumer. But price to book down here at 283 times book value, and again, that is the lowest it's been, going all the way back to the tail end of 21. So again, that's why a lot of these fundamentals do look attractive, but at the same time, I'm just going with my gut feeling here that we can potentially get a better price. But you can see the return on assets, equity, invested capital. You can see they had little dips down a couple of quarters ago and have since rebounded for the last 2 quarters in a row. And even this, the gross margin percentage was almost up to 22, dipped all the way down to sub 18, and now it's kind of reversing, 18.68, 21.75. But again, my concern is that now, they're increasing over the last couple of quarters, because it was this time last year that they were at the high. So now they're going from the decrease back to the increase, and potentially back into another decrease. You understand what I'm saying? So that's why I feel like even though some of these numbers have rebounded a little bit, I think now we're on the roller coaster ride, and we were down, and now we're up, and now we're going to go down again. The operating margin, again, dropped down to 6.12 when it was above 7. And then slowly been climbing, 6.65, now above 10. EBITDA was double digits, drops down to 9.5, now been climbing up, 10.28, 13.67. And the profit margin we looked at before, and we went from negative to positive, back up to 4%. But again, if they're expecting profitability to now begin to drop and step down as it did this time last year, that's what I mean. Those are all going to be reasons as to why Wall Street is going to lower price targets and push the sell button as opposed to pushing the buy button. Inventory turnover looking pretty good, but of course bouncing around. Was up here at 97, 89, down to 70, then jumps up to 94, and now 83. Now that's what I mean. Next quarter it could be like 73, and that'll be just another reason as to why everyone could bet against the stock. I just think it really comes back down to earnings. And again, if we go back, this time last year was the best quarter on record. So now, with that same quarter now coming up around November 2nd, this is going to really determine where the stock is going to go. Because I think if they come in light here, especially on the revenue side, I think they're really going to beat up the stock and bring it down to the 12s and the 11s. But they do need the beat there. And I have a feeling that it may not even rally until about a week before that. And that's why now here, October 11th, you have probably, in my opinion, about 2 weeks before you may even want to consider stepping in and rolling the dice. But again, that's going to be purely an earnings play, so you have to understand those risks involved. If they miss those numbers, you're screwed. And if you have any naked calls, they're going to get completely destroyed. But, could be worth a shot in the shorter term. And, that's pretty much it. I could, of course, pull up stock charts here. Sorry, I had it on the other screen. But we'll bring up Portillo's quickly. And we'll throw on our Bollinger Bands quickly. And you can see that since right before they posted earnings, and of course since then, they brought the stock below the mid-Bollinger Band and have kept it down there for the last 3+ months. And you can see we had a couple of attempts to try to get above, and we just had these rejections, and now we have this downgrade here from Morgan, so obviously that had them completely drop down. And, now the MACD was rising, and it looks like it's curling and could potentially cross back to the downside. Your RSI is sitting here at just a touch above 26, which is ridiculous. However, again, for like this 4 to 5 week window here on the daily, the stock was sub 30. And has kind of been trash, really, for the last 3 months. So even though the RSI, again, does look attractive, in my opinion, it really can't be your indicator right now, even though it does look oversold. Switching here on the weekly, you can see we're just kind of riding the bottom Bollinger Band here, and now we have this widening taking place, this trumpeting happening here with the Bollinger Bands. And of course, because the stock was so much higher, on the weekly, you now have a 50-day moving average north of $20, right? So that's almost a 50% move to get back to that moving average. And same thing here on the daily. Again, the stock was just overinflated, in my opinion. Now they bring it down. I mean, your 50-day here, 1736. That's why it's going to take that big earnings report to even try to attempt to get back to that 17+ level. And, of course, the 200-day. Slightly above $20 here as well. So I think it's going to take time. And again, I personally wouldn't be looking to force my way in here at 1460. I would look maybe for like 1260. I would let it be so undervalued in the numbers that it completely falls off everyone's watch list, and now under the radar, it finds that bottom, it finds that footing, and it begins to reverse out of it. On the weekly, you can see the RSI is down at about 29.25, which could be actually a decent indicator, because if you go back here, you can see when it approached that benchmark, that's when we went on a little bit of a tear throughout July and August. So we could have a bounce sometime soon, but again, I have a feeling that we're going to come back down towards that bottom trend line there, which of course would be sub 14. And again, that's more for an immediate trade, but still, I'm sure you'd rather buy a stock under $14 than at $14.63. Also, I wanted to show the pivot points quickly because, yeah, as you see right here, the previous support level looks like it was about $14.65, and now you see the stock very close to that level, but it technically closed below that support line of 1465, which means technically it should continue to drop down and approach this next support level there of 1415. But if it does drop a couple of percentage points down, again, that may bring us to a potential cross on the MACD, which could potentially break that level and bring us down into the 13s. That's why I'm saying we could potentially, like down here, like 1291. That's why I feel, in my opinion, you could get that price. And again, just my opinion, but I would wait. I would be a little patient here with Portillo's. Obviously, if you like what they're doing, or you're involved with the stock, or you think that one day it's going to be back above 20, 9 months from now, obviously let us know down in the comments section how you feel about the stock, if you have a position, if you like it and you're going to continue to hold it, or if you think, it may get rocky, so you may be looking to liquidate and maybe get back in down the road. I'm always curious to hear everyone's strategies about a lot of these stocks that we look at. So definitely let us know down in the comments section. And of course, if you have any questions or concerns, let me know down in the comments section. I'm usually very quick to reply. But we'll end it there. So stocks by the numbers, thumbs up, algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. I'll do videos like this. I'll give update videos on smaller cap stocks like SoundHound and STEM Inc. And even if you want to come in the Discord, BS a little bit, maybe if I have a couple of day trades or scalp trades, I'll try to let you guys know in the Discord. Link in the description of every video. I'll do all of that for you guys. All I ask, do me a favor, push the subscribe button. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky and volatile and uncertain, so I want to wish all of you success. Hope everyone makes a couple of bucks. Thanks for stopping by. Catch you in the next one.